What's up, guys, and welcome to the Economic Outlook. The stock market has long been a place for ordinary people to build wealth and achieve financial freedom. You can work hard at your 9-to-5 job and use some of your salary to buy stocks. After a few decades of investing, hopefully your portfolio will have grown enough such that you can enjoy a comfortable retirement. But what if instead of having to work for a living, you had unlimited money available to you? Would you use this money to buy stocks? If so, how much would you buy? While this might sound like an absurd thought experiment, it is actually happening in the real world as we speak and on a massive scale. Over the past few years, the Bank of Japan, or BOJ for short, has printed roughly 38 trillion Japanese yen, which is worth the equivalent of 350 billion US dollars, and they have used this money to invest in Japanese listed stocks. The BOJ is now the single largest holder of Japanese stocks, owning roughly 8% of the country's entire stock market. And they have done pretty well on the investment, making more than $80 billion worth of unrealized gains. This is more trading profits than any hedge fund has ever made. While central banks around the world have resorted to unconventional monetary policy for quite some time now, printing money for the express purpose of buying stocks is on a whole new level of extreme. No country other than Japan has ever done this, and the consequences for the economy could be severe. In this video, we'll discuss why the Bank of Japan is doing this, as well as what impacts it will have on the country's stock market and economy. To understand the BOJ's stock buying spree, we must first understand the long-standing economic issues the country has faced. In 1990, the country's stock and real estate markets had an epic collapse that tanked the economy into a deep recession. The recession was so protracted that it became known as Japan's lost decade. In fact, it would be more appropriate to call it Japan's 3 lost decades, as they have failed to sustain real GDP growth even to this day. There is much debate about the causes of the country's stagnation, but it can largely be attributed to their low birth rate and aging population. We've made a video in the past exploring this issue in detail. The link is in the description below. But for the purposes of this video, you just need to know that Japan's economy has suffered from stagnant growth and low inflation since the 1990s. The central bank has a few tools to help stimulate the economy back into growth. The first tool central bankers look to is so-called traditional monetary policy, which involves the setting of interest rates. When the central bank lowers interest rates, businesses should be encouraged to take out more loans and invest in new projects. It also reduces mortgage rates, which will spur demand for new residential housing. The BOJ steadily lowered its policy interest rate until it reached zero in the early 2000s. At this point, the conventional monetary policies seemed to be doing the trick. GDP growth and inflation were rising as the global real estate bubble was inflating. It looked like the economy was returning to growth, and the BOJ even raised interest rates modestly during this period. But in 2008, the real estate bubble finally burst, which triggered the bankruptcy of US investment bank Lehman Brothers. This sent the entire world, including Japan, into a steep recession. In response, the BOJ cut its interest rate back to zero. But the lowering of the interest rate did not spur the desired increase in private sector investment. Growth remained anemic, and inflation remained below the BOJ's 2% target. With the bank's policy interest rate already at the zero lower bound, they would have to move beyond traditional monetary policy and try some more creative methods. The first thing they attempted was quantitative easing, or QE. Under QE, the central bank prints money to buy long-duration financial assets. They usually buy very safe assets, such as 10-year government bonds. QE is not unique to Japan. Both the US Federal Reserve and the European Central Bank have also embarked on multi-trillion-dollar QE programs. The BOJ started off by buying Japanese government bonds. They did this very aggressively and currently own more than 1/2 of total debt issued by the government. This policy successfully decreased the 10-year yield to roughly 0%. Most corporate bond yields are priced as a markup to government bonds. Reducing the government's borrowing costs indirectly reduces corporate borrowing costs. In theory, this should increase corporate investment. However, Japanese corporations were still shell-shocked from the global financial crisis as well as the market crash back in 1990. This caused them to be very conservative and reluctant to take on new debt even when interest rates are low. This put the BOJ in a conundrum. With the traditional QE policies, they could only reduce corporate borrowing costs. Since corporations didn't want to borrow, this had very little effect on the economy. The Bank of Japan had to get even more creative. There are 2 ways a company can raise capital for new investments. If they don't want to borrow money, they can instead issue new stock. The higher the company's stock price, the less dilutive it will be to issue new shares, and thus the executives will be more willing to issue new stock to fund new projects. For example, after AMC's short squeeze, the company issued hundreds of millions of dollars worth of new shares at elevated prices. They can use this money to build new movie theaters, which will create jobs and help boost economic growth. Additionally, if stock prices go up, people who own stocks will become wealthier. This should encourage them to spend more money, which will also boost the economy. The BOJ wanted to make stock prices go up. The simplest way to do this is by printing massive amounts of money and buying them on the open market. They started buying ETFs of Japanese stocks in 2010. At first, it was just a few $billion, but over time, they increased their investment to $350 billion. As the market has risen during this period, their current portfolio is now valued at $430 billion, making them the single largest owner of Japanese stocks in the world. The BOJ seems to have achieved their goal of inflating stock prices. Since they started buying ETFs, the Nikkei 225, which is the country's main stock market index, has appreciated 180%. But the effects on real economic growth are far more ambiguous. Economies are complicated, and it is difficult to isolate the effect of the rise in stock prices. GDP growth has been positive in the 10 years following the program's launch, but was significantly below that of other developed countries such as the US. Proponents of the BOJ argue that growth would have been even slower had it not been for the central bank stock buying. On the bright side, unemployment has been falling steadily and reached a low of 2.5% before the pandemic. Part of this decline can be attributed to the aging population. As more people enter retirement, the unemployment rate will decrease, just as a function of a lower percentage of the population being in the workforce. But there are clearly negative side effects of the BOJ's radical policy, the most obvious of which is distortions in the stock market. The BOJ is currently a top 10 shareholder in 40% of Japanese listed stocks, and owns 8% of all outstanding shares in the Tokyo stock market. 8% doesn't seem like that much, but the ownership is not equally distributed across all stocks. Their main ETF holding is on the Nikkei 225 index. The Nikkei 225 is a share price weighted index similar to the Dow Jones Industrial Average in the US. Companies with higher share prices have a disproportionately large weighting in the index. For example, Uniqlo's parent company Fast Retailing has the largest weighting in the index because its stock price is so high. Toyota, which has a market cap nearly 4 times greater than that of Fast Retailing, has a much lower index weighting because its share price is much lower. So while the Bank of Japan only owns 8% of the total stock market, they ended up building an 18% stake in Fast Retailing. To make matters worse, most of the company's shares are owned by founders and strategic investors, which makes the free float much smaller than the market cap. As of 2018, the BOJ owned 70% of Fast Retailing's free float. Since 2010, Fast Retailing stock has massively outperformed the broader market, increasing 450%. While some of this can be attributed to the company's strong operational performance, much of it is the result of buying pressure from the Bank of Japan. Stocks are supposed to be valued based on the underlying fundamentals of the company. This is how capital is allocated to the best companies. But when companies like Fast Retailing can be pumped up for purely technical reasons, this can distort markets and cause an inefficient allocation of capital. Another negative aspect of the BOJ stock buying program is its effect on corporate governance. Sometimes, a company's CEO will make decisions that are not in the best interest of shareholders. For example, ex-WeWork CEO Adam Neumann spent corporate money on private jets and elaborate parties. Activist investors such as Bill Ackman buy up stakes in mismanaged companies and push to replace the management team. The Bank of Japan is a passive investor, which means they would not try to remove the company's existing management. If you were the CEO of Fast Retailing, you could take comfort in the fact that your largest shareholder will never criticize your management or try to remove you. This may embolden you to increase your own salary or engage in vanity projects that are detrimental to shareholder value. While the BOJ's stock buying experiment has succeeded in boosting the market, the economic effects have been limited at best. The economy still faces structural problems such as an aging population, which the central bank cannot solve, and the long-term effects of market distortion still remain to be seen. Alright guys, that wraps it up for this video. Do you think the BOJ should continue buying stocks? Let us know in the comments section below. If you enjoy this content, make sure to hit the like button and subscribe so you don't miss future uploads. As always, thank you for watching and we'll see you on the next one.